Hello and welcome to this session. This is session 5 of Unit 2 Regulatory Framework for Public Finance in Ghana. This is a continuation for the previous session where we looked at the qualitative characteristics of of the general purpose financial reports and also some of the constraints of the information provided by the general purpose financial reports. So in this session we'll be focusing more on who the public entities are, as the covered entities, those reporting entities, who they are, and also which elements should be recorded in the public sector financial statement, and at what value should these elements or these items be reported or recorded in the public sector financial statement. So by the end of the session, we would be able to identify and explain the elements of public sector financial statement. We would also be able to measure to explain the measurement basis for elements of public sector financial statement. Let's look at what a reporting entity is and then who qualifies to actually be a reporting entity. So I say a public sector reporting entity is a government or other public sector organizations, program or identifiable area of activity that prepares general reports, financial reports. So it's not just the entities that are public sector reporting entities, no, but then if there is any government project or if there is any government activity that is going on that prepares general reports, financial report to the public or to any of the stakeholders, then this particular activity or entity or program can be said to be a reporting entity. So we are saying a reporting entity has the following characteristics. It has authority and capacity to direct the activities of one or more public sector entities so as to benefit from the activities of those entities. And has the reporting entity is a government entity or other reporting entity that can be exposed to a financial burden or loss that may arise as a result of those activities. So these are some characteristics that we are saying, if when available, we can say that that particular entity, activity or program is a reporting entity in the public sector. So these are key characteristics of public sector reporting entity. We are saying it's an entity that raises resources from or on behalf of the constituents or uses resources to undertake activities for the benefit of or on behalf of those constituents, and then also their service recipient or service provider dependent on the general reports, financial reports of the entity for information, for accountability and decision making purposes. So these are also some characteristics of the public sector reporting entity. So now let's consider the elements that should come into the financial statement of a public sector entity. This is very similar to those elements that we have for normal financial reports in terms of private entities. They are very similar. We have the same assets, liabilities, expenses, income, and then net financial position, which in the case of a private entity we might say equity or capital. So assets are those resources that are controlled by the entity as a result of past events that may result in a future cash inflow into the business. So basically assets, we are saying assets are resources presently controlled by the entity as a result of past events. So if the entity has any resource currently and then it is there because of an activity or an event that occurred previously and may lead to a future benefit coming to the business, then that particular resource is an asset to the business, right? A liability, on the other hand, is a present obligation of the business, which is also as a result of a past event that may lead to a future outflow from the business. So if the business has any obligation at all, currently the business has an obligation which comes from a previous event that occurred and will result in the business paying or outflows leaving the business, then that particular resource item is a present obligation of the business, i.e. being a liability to the business. So net financial position is the difference between an asset and liability after adding other resources and deducting other obligations. So that's basically the capital that we are talking about. So for public sector entities, mostly they are called accumulated funds. So this is just a surplus of the assets to the liability. So if there is any surplus of the assets when compared with the liability, then that give rise to a net financial position to the public sector entity. So surplus or deficit. Surplus or deficit is basically the difference between the revenue and expenses reported in the statement of financial performance. So if there is a difference between the expense and then the income of the business, then that gives rise to a surplus or a deficit. So revenue, on the other hand, are all the inflows to the business as a result of the operations of the business. So an entity like Ghana Water Company, which is known for providing water services to the citizens, its revenue or its main source of revenue may be the recoveries or the income that they get from charging water costs to the citizens, right? So these are that should be a revenue line item to them, and that will be part of their revenue. And basically, their expenses, we are looking at any outflow that is due to their normal operations. So that basically their expense side, the expenses. Right. We also have the ownership contribution. These are inflows resources to an entity contributed by external parties in their capacity as owners. So basically, if there are any other shareholders to, or there are shareholders to that particular public sector entities, then the resources or funds from these owners are known as the owners contribution. Then owners distribution, outflows of resources from the entity distributed to external parties. So if the public sector entity makes any distribution to the owners, then that becomes owners contribution. Now let's look at the basis for how we should value this element in our books. So how, if you are talking of an asset, how should you record the asset in the books, or how should the public sector entity record the asset? At what value, at what amount should the public sector entity record the assets, the liability, or the expense or income in their books? Very first one being entry and exit value. So this one, as the name suggests, entry and exit value. So the entry value, we are looking at the values which the asset is initially recognized in the books, while the exits, we are looking at the values at which the assets are derecognized from the books. So the entry, as and when you bought the asset, the initial recognition of that particular asset, that's the entry. And then the exit, we are looking at when the asset was going out, what was the value of that particular asset as at the time it was going out, or it was being derecognized in the books. Observable and unobservable values. Saying observable means the valuation methods are likely to be more understandable, right, and verifiable, or may be more faithfully represented of the phenomena than unobservable. Unobservable meaning the valuation method, we cannot actually verify the method. It was due to some estimated assumptions by these valuers. So that's another way of measuring the items in the general report, financial report, the entity specific and non-entity specific. So an entity may choose a way to value a particular item, and that's entity specific. Non-entity specific are the general ways of valuing some items. So entity specific are what the entity chooses to value that particular item, and then non-entity specific, those are the general valuation that we have for some of these items already. So the measurement basis for assets, we have asset being measured at historical cost, current value measurement, market value, and replacement cost. For historical cost, we are saying the consideration given to acquire or develop an asset. So that's the very initial cost. So upon initial recognition, the cost that asset came with, that's the historical cost. The current value measurement reflects the economic environment prevailing at a reporting date. So here, the value of the asset actually considers what is currently going on. So currently in Ghana, we know that there is some form of economic hardship in there. So if an entity adopts the current value measurement basis, then the value of its item in its book should reflect the economic hardship as well. Okay, we also have market value. So market value, we are looking at how much these assets can be exchanged with knowledgeable willing parties in an arm's length transaction. So if you go into the market, how much would somebody offer for that particular asset that you owe or you own? Yeah. Then we have the replacement cost. Is the amount that that particular asset will be replaced with. So basically, we are looking at how much that asset can be sold for in the market. It's different from the market value. The market value, we are looking at how much you might get or somebody is willing to pay, but then the replacement cost is how much you would actually gain when that particular asset is being sold. People would always want to buy stuff lower than they actually cost, so the market value may be higher than how much it will cost you to replace that particular asset. Then we have the net selling price. That's the amount that the entity can obtain from the sale of the asset after deducting the cost of sale. Then we have the value in use. The value in use is basically you discounting any future benefits or cash flows from the use of that particular asset. So you discount the benefits that that particular asset will derive for you in the future into its present value, and then that becomes the value used for the asset. Let's look at some measurement basis for liabilities. We have the cost of fulfillment, market value again, cost of release, and assumption price. Cost of fulfillment, this is the cost that the entity would incur in fulfilling the obligations represented by the liability. So how much the entity will actually incur in undertaking that particular obligation. That's the cost of fulfillment. The market value, how much the entity will settle that particular liability between knowledgeable and willing parties in an arm's length transaction. The cost of release, in terms this one we are talking of how much the entity will incur if the entity is trying to sell off that particular debt today, right? Then the assumption price, the term used for liability to refer the same concept as the cost of sales. That's the assumption price. So this is basically the end of this session, and we have learned the measurement basis for assets and liabilities of public sector entities, and we've also looked at the element that goes into the general report, financial reports, and who a public sector reporting entity and some characteristics of a public sector reporting entity.